Markets don't crash because of bad news. They crash because of good news that's too good to be true. Right now, artificial intelligence stocks are soaring, margin debt has hit record highs, and everyone from your barber to your banker thinks the party will never end. But if you know how to read the signs, you've seen this movie before. Twice. In 1929, it was radio and automobiles that promised to change everything. In 2008, it was housing that could never fall. Today, it's artificial intelligence that will supposedly make us all rich. The script is different, but the ending is always the same. When markets reach extreme valuations, when speculation runs wild, when everyone believes this time is different, that's when the trap snaps shut. And right now, we're seeing warning signals that mirror both the 1929 crash and the 2008 financial crisis with terrifying precision. The question isn't whether a crash is coming. The question is whether you'll recognize the signs before it's too late. Let's start with 1929, because understanding that collapse is the key to understanding every bubble since. The Roaring Twenties weren't called roaring because people were happy. They were called roaring because money was flowing like a river, stocks were climbing like rockets, and everyone thought they had discovered the secret to permanent prosperity. Sound familiar? It should, because we're living through the same delusion right now. In the spring and summer of 1929, the American economy was riding high on a decade-long winning streak. The stock market had been on a 9-year run that saw the Dow Jones Industrial Average increase in value tenfold, peaking at 381 on September 3rd. But here's what most people don't know. The warning signs were everywhere. Steel production was declining. Construction was sluggish. Automobile sales were dropping. Consumer debt was exploding because credit was so easy to get. Yet stocks kept climbing because everyone believed the market would rise forever. The average price-to-earnings ratio of stocks in the S&P Composite hit 32.6 in September 1929, clearly above historical norms. But nobody cared about fundamentals because speculation had replaced investing. Roughly 600,000 margin accounts were held by brokerage firms out of a total national population of 120 million Americans. That means 1 in every 200 Americans was gambling with borrowed money on stocks. Credit was extended so generously that new investors only needed to put down 25% of a stock's value, borrowing the other 75% from their brokers. The Federal Reserve was raising interest rates to cool the booming market, but speculators ignored the warnings. Even when a small crash occurred on March 25th, after the Fed warned of excessive speculation, stocks resumed their advance by June. Economist Roger Babson warned in September that a crash was coming that would cause the Dow to decline by 60 to 80 points. He was right, but nobody listened because everyone was making too much money to care about risk. Then came the famous words of economist Irving Fisher, who proclaimed just before the crash that stock prices had reached what looked like a permanently high plateau. Those words became the epitaph of an entire generation of investors who confused a bull market with genius. When the crash finally came, it wiped out fortunes, destroyed banks, and launched the Great Depression. The lesson was clear. When everyone believes prices can only go up, that's when they're about to go down. Fast forward to 2008, and the script repeated with eerie precision. Instead of stocks, it was housing that could supposedly never fall. Instead of margin accounts, it was subprime mortgages that let people buy homes with no money down. Instead of radio and automobile companies, it was banks packaging toxic loans into securities they claimed were safe as government bonds. Housing prices had peaked in 2006, and mortgage delinquencies were rising, but few paid attention to these early warning signs. 1/3 of all mortgages in 2006 were subprime or no documentation loans. Think about that. Banks were lending money to people without even checking if they could pay it back. Subprime lending standards had collapsed so dramatically that by 2005, many lenders had dropped the required credit score from 660 to 620, making it easier to qualify for loans while making the entire system more dangerous. The share of subprime mortgages among all home loans increased from about 2.5% in the late 1990s to nearly 15% by 2007. Proof of income and assets was de-emphasized as loans went from requiring full documentation to low documentation to no documentation. People were getting mortgages based on nothing more than their signature and a prayer that housing prices would keep rising forever. Just like in 1929, leverage was the accelerant that turned a correction into a catastrophe. In 2004, the Securities and Exchange Commission relaxed the net capital rule, which allowed investment banks to substantially increase their debt levels. Banks that had been conservative for decades suddenly loaded up on mortgage-backed securities, thinking they had found a way to eliminate risk through diversification. They were wrong, and when the housing bubble burst, the entire financial system nearly collapsed with it. The Federal Reserve had raised interest rates significantly between 2004 and 2006, making adjustable rate mortgages more expensive for homeowners and contributing to the deflation of the housing bubble. But just like in 1929, the warning signs were ignored because everyone was making too much money to worry about fundamentals. Now look at where we are today, and the parallels are impossible to ignore. Financial journalist Andrew Ross Sorkin warns that the Wall Street of today echoes the market of 1929, describing the current era as a new roaring 20s. Stocks are pushing to record highs just as they were in the 1920s, but this time the mania is centered on artificial intelligence instead of radio and automobiles. The numbers are staggering and terrifying. The Buffett indicator, which Warren Buffett champions as probably the best single measure of market valuation, has soared to unprecedented levels, hovering around 220% as of late 2024. That's more than double its historical average, and well past the 200% mark that Buffett himself warns means investors are playing with fire. The Shiller price-to-earnings ratio, which smooths out earnings over 10 years to get a clearer picture of valuation, is sitting at over 40 as of late 2024. That makes it the second highest level ever recorded, trailing only the peak of 44 observed just before the dot-com bubble burst in 2000. Its long-term historical average is around 16, which means stocks are trading at more than double their normal valuation. These aren't abstract numbers. They're warning sirens screaming that the market has become detached from reality. History shows us that valuation premiums of this magnitude aren't sustainable. The 5 previous times the Shiller ratio topped 30 and held that level were eventually followed by declines ranging from 20 to 89%. But the valuation metrics are just the beginning. Margin debt, the amount of money investors are borrowing to buy stocks, reached a record $937 billion in January 2025, marking a 33% increase from the previous year. During the same period, the S&P 500 gained less than 25%, which means investors are taking on more and more debt to chase smaller and smaller gains. The willingness of investors to embrace outrageous risk has reached levels that would make 1929 speculators blush. Single stock ETFs, which allow investors to make leveraged bets on individual companies, have exploded in popularity. Between 2022 and 2024, the number of these instruments jumped from 17 to 102, with roughly 60% being leveraged products that can amplify both gains and losses. Companies are now filing for new leveraged ETFs that would allow 5 times leverage on individual stocks. This comes at a time when margin debt hit an all-time record, demonstrating what a potentially dangerous bubble the stock market has become. History shows that 55% of all leveraged ETFs eventually close down, and 17% go on to lose more than 98% of their value. The artificial intelligence boom driving this market euphoria bears striking resemblances to the speculative technology bubbles that preceded both major crashes. OpenAI's valuations surged beyond $100 billion, despite reports of spending $8.5 billion on training and staffing, while projecting a $5 billion loss. Market veterans see uncomfortable parallels with the dot-com bubble's excessive optimism as investment capital continues pouring into artificial intelligence. Just like in 1929 and 2008, traditional financial metrics are being abandoned in favor of new measures that justify higher valuations. Investors are shifting focus from established indicators like price-to-earnings ratios to novel metrics that make expensive stocks seem reasonable. It's the same pattern that appears in every bubble. When reality doesn't support the prices, people simply change how they measure reality. The signs are everywhere if you know where to look. The question is whether you'll heed the warnings or join the crowd rushing toward the cliff. The rush of retail investors into the market has reached fever pitch, with speculative trading becoming wildly popular among younger investors using commission-free platforms. The bull-to-bear ratio has tilted heavily toward euphoria, reflecting the kind of widespread optimism that historically marks market tops. When seasoned investors start worrying about sustainability, it's because they see newer players piling into the market, where fear of missing out overrides any concern for fundamentals. This isn't just about individual stocks or sectors anymore. The entire global financial system has become a web of interconnected risks that could amplify any downturn beyond what we saw in previous crashes. Securitization and globalization have created connections between institutions that span continents, making local problems global catastrophes. Remember how German banks somehow ended up exposed to American subprime loans in 2008? Today, those connections are exponentially more complex and dangerous. Shadow banking activities continue expanding outside traditional regulatory oversight, potentially harboring risks similar to those that nearly destroyed the world economy 15 years ago. These less regulated entities lack sufficient capital buffers, creating vulnerabilities that could cascade through the system faster than regulators can respond. It's the same game of regulatory arbitrage that created the mortgage crisis, just with different players and different instruments. The debt numbers alone should terrify anyone paying attention. Global debt has reached a staggering $315 trillion, representing 331% of global GDP, according to the Institute of International Finance. That's not sustainable growth. That's a powder keg waiting for a spark. American corporate debt has escalated to approximately $12.1 trillion, a massive increase from pre-pandemic levels that creates instability should economic conditions deteriorate. But here's where it gets truly frightening. The derivatives market presents hidden risks with notional values estimated at over $600 trillion globally. That's a complex web of financial instruments that can amplify market disruptions in ways that make 2008 look like a practice run. When confidence breaks in a system this leveraged, the cascade happens at the speed of light, not the speed of human decision-making. The federal government's position makes the situation even more precarious. With federal debt approaching $34 trillion, interest payments now consume roughly 15% of the federal budget. That means the government's ability to respond to a crisis has been severely compromised compared to previous downturns. Political gridlock makes effective fiscal policy implementation nearly impossible, potentially delaying or diminishing crisis response measures when they're needed most. Meanwhile, central banks have exhausted much of their ammunition after years of low interest rates and quantitative easing diminishing returns. The Federal Reserve in easing, monetary policy interventions faced other central banks have less room to maneuver than they did in 2008. Which means the next crisis will have to be fought with fewer and weaker tools. The artificial intelligence narrative driving current valuations follows the same psychological pattern as every bubble in history. Just as the internet was supposed to revolutionize everything in 2000, just as housing was supposed to be a guaranteed investment in 2007, artificial intelligence is being sold as the solution to every problem and the path to unlimited prosperity. The technology may be revolutionary, but the financial mania surrounding it is depressingly familiar. Investment capital pours into companies with no profits, no revenue, and sometimes no actual products beyond PowerPoint presentations and press releases. Valuations are justified not by earnings or cash flow, but by the promise of future dominance in markets that may not even exist yet. It's the same suspension of financial logic that characterized every major bubble, dressed up in the language of innovation and disruption. The breadth of the current market tells the real story. While headline indices reach new highs, the percentage of stocks actually participating in the rally has plummeted since February. Performance is being driven by a handful of mega-cap technology companies, while the majority of stocks hang limp. This concentration of gains in a few names is a classic warning sign that the market has lost its foundation and is being held up by speculation rather than broad-based economic strength. Ray Dalio's criteria for identifying bubbles paint a disturbing picture of current conditions. High prices relative to traditional metrics, unsustainable growth expectations, an influx of inexperienced investors, widespread bullish sentiment, debt-fueled buying, and speculative purchases. The current market exhibits most, if not all, of these characteristics. When professional investors who've seen multiple cycles start using the word bubble, it's time to pay attention. The velocity of modern markets means that when confidence breaks, the cascade happens faster and more violently than in previous eras. High-frequency trading, algorithmic decision-making, and global interconnectedness create feedback loops that can turn corrections into crashes in minutes rather than days. The flash crashes we've seen in individual stocks provide a preview of what could happen to the entire market when the mood shifts from greed to fear. Consumer behavior shows the same dangerous patterns that preceded both major crashes. Credit card debt has soared as people maintain lifestyles their incomes can't support, assuming that rising asset prices will eventually bail them out. Buy now, pay later services have exploded in popularity, allowing people to purchase goods they can't afford with the same casual attitude toward debt that characterized the housing bubble. The student loan crisis adds another layer of systemic risk, with borrowers owing more than $1.7 trillion in educational debt that often can't be discharged in bankruptcy. This debt overhang constrains consumer spending and creates a generation of workers who start their careers already underwater financially. When the job market turns, these borrowers become casualties rather than consumers. Housing markets in major metropolitan areas have reached levels of unaffordability not seen since 2006. Median home prices in cities like San Francisco, New York, and Los Angeles require incomes that only a tiny percentage of workers can achieve, yet prices continue climbing because speculation and investment demand have replaced actual housing need as the primary driver of purchases. The commercial real estate sector faces its own crisis as remote work has permanently reduced demand for office space. Vacancy rates in major business districts have reached levels not seen since the 1990s, yet property values remain elevated because owners refuse to accept reality. When those values eventually adjust to actual rental income, the losses will ripple through regional banks and pension funds that hold these properties as supposedly safe investments. International markets provide no refuge from the gathering storm. European banks remain fragile despite years of supposed reform. Japanese markets trade on momentum rather than fundamentals, and emerging market economies face the double threat of dollar-denominated debt and capital flight when American interest rates rise. The interconnectedness that was supposed to spread risk has instead created a system where problems anywhere become problems everywhere. The warning signs are flashing red across every metric that matters, yet the party continues because everyone assumes someone else is watching the exits. But in markets, as in history, the exits are always narrower than they appear, and everyone tries to leave at the same time. The crash doesn't announce itself with sirens and flashing lights. It arrives when confidence evaporates and everyone discovers simultaneously that the emperor has no clothes. The most chilling aspect of our current situation isn't just that we're repeating the mistakes of 1929 and 2008, it's that we're making them bigger, faster, and with more leverage than ever before. The tools of speculation have evolved, but human nature hasn't. The greed, the euphoria, the absolute certainty that this time is different, it's all exactly the same. Only the scale has changed. Consider the speed at which modern bubbles inflate and burst. In 1929, it took months for the crash to fully unfold. In 2008, the crisis played out over weeks. Today's markets can collapse in hours. When algorithmic trading systems start selling, they don't pause for lunch breaks or sleep. They execute millions of trades per second, turning what might have been an orderly correction into a catastrophic rout. The same technology that's supposed to make markets more efficient has made them exponentially more dangerous. The cryptocurrency mania provides a perfect preview of what happens when speculation meets modern technology. Digital assets with no underlying value beyond collective belief soared to market capitalizations larger than entire countries, then collapsed by 80% or more in a matter of months. Fortunes were made and lost in the time it takes to refresh a browser. Yet instead of learning from this cautionary tale, traditional markets have embraced the same mindset of infinite upside with no consideration of risk. Exchange-traded funds have become the new margin accounts, allowing ordinary investors to make leverage bets they don't understand with money they can't afford to lose. Triple-leveraged ETFs that promise 3 times the daily return of an index have attracted billions in assets from people who have no idea they're essentially gambling at a casino where the house always wins in the long run. When volatility spikes, these instruments don't just lose money, they vaporize it. The options market tells an even more disturbing story. Daily options volume has exploded as retail investors chase lottery ticket payoffs from trades that expire worthless 90% of the time. Apps gamify investing, turning portfolio management into a video game complete with confetti animations when trades are executed. Young investors treat their retirement accounts like slot machines, convinced they can beat professional traders using nothing but social media tips and YouTube tutorials. Social media has replaced financial advisors for an entire generation of investors who get their market analysis from TikTok videos and Reddit threads. The democratization of information was supposed to level the playing field, but it's actually created an echo chamber where bad ideas spread faster than good ones. When everyone in your feed is making money, it's easy to believe that investing is simple and risk is obsolete. The herd mentality that drove previous bubbles now operates at internet speed. Corporate behavior mirrors the same reckless optimism that preceded earlier crashes. Stock buybacks have reached record levels as companies borrow money to purchase their own shares, artificially inflating prices while weak than investing in productive capacity or earning their balance sheets. Rather, research and development manage fix of financial engineering. When revenues mints have chosen the quick eventually disappoint, these companies will find themselves over-leveraged and underinvested, vulnerable to any economic downturn. The merger and acquisition boom follows the same pattern of empire building that characterizes market tops. Companies pay ridiculous premiums for acquisitions that make no strategic sense, justified by synergies that never materialize and cost savings that never appear. Private equity firms load healthy businesses with debt, extract fees, then leave the shells to collapse when economic conditions tighten. It's financial strip mining disguised as value creation. Pension funds and insurance companies, desperate for yield in a low interest rate environment, have abandoned their traditional conservative approach and piled into riskier assets. These institutions that are supposed to provide stability for retirees and policyholders have become speculators, chasing returns in private equity, hedge funds, and illiquid investments they don't fully understand. When the bubble bursts, it won't just be individual investors who suffer. It will be entire generations whose retirements depend on these supposedly safe institutions. The international dimension adds layers of complexity that didn't exist in previous crashes. Currency wars, trade disputes, and geopolitical tensions create cross-currents that can turn local problems into global catastrophes. Supply chains that span continents mean that disruptions anywhere can cascade everywhere. The just-in-time efficiency that maximizes profits during good times becomes a vulnerability when things go wrong. Central banks around the world have painted themselves into a corner. After years of quantitative easing and near-zero interest rates, they've created asset bubbles while failing to generate sustainable economic growth. Raising rates now risks triggering the very crash they've been trying to prevent, but keeping them low perpetuates the speculation that makes an eventual reckoning even more severe. They've become prisoners of their own policies, forced to keep feeding a bubble they know will eventually burst. The wealth inequality that these policies have created adds social and political instability to the mix. When asset prices soar while wages stagnate, the benefits of economic growth flow disproportionately to those who already own financial assets. This creates resentment and populist backlash that can manifest in unpredictable political outcomes. Markets that depend on stable institutions and predictable policies become vulnerable to sudden shifts in the political landscape. Banking regulation, supposedly strengthened after 2008, has been systematically weakened through regulatory capture and political pressure. The Volcker rule has been watered down, capital requirements have been relaxed for regional banks, and stress tests have become exercises in creative accounting rather than genuine risk assessment. The same institutions that required taxpayer bailouts 15 years ago have returned to many of the same practices that created the crisis in the first place. Student debt, credit card balances, and auto loans have created a consumer base that's financially fragile despite appearing prosperous on the surface. Monthly payment financing allows people to maintain lifestyles their incomes can't support, creating the illusion of affordability while building unsustainable debt burdens. When unemployment rises or interest rates spike, these consumers don't gradually reduce spending, they stop spending entirely, creating deflationary spirals that feed on themselves. The housing market exhibits the same detachment from fundamentals that characterized the mid-2000s bubble. Investors and speculators have crowded out actual home buyers in many markets, treating residential real estate as just another financial asset rather than shelter. Rent-to-own schemes, iBuyers, and corporate landlords have financialized housing in ways that increase systemic risk, while making home ownership less accessible for ordinary families. Commercial real estate faces a reckoning that could make the residential crisis look manageable. Office buildings worth hundreds of millions during the pandemic now struggle to find tenants as remote work becomes permanent. Regional banks that concentrated their lending in commercial properties face potential insolvency as property values adjust to new realities. The ripple effects will spread through pension funds, insurance companies, and municipalities that depend on property tax revenue. Energy markets add another layer of instability as the transition away from fossil fuels creates stranded assets and obsolete infrastructure. Oil companies that seemed invincible just a few years ago now face existential questions about their long-term viability. The green energy boom exhibits many characteristics of speculative bubbles, with companies valued on promises rather than profits, and government subsidies creating artificial demand that may not persist when political priorities shift. The derivatives market that nearly destroyed the global financial system in 2008 has grown exponentially larger and more complex. Credit default swaps, interest rate swaps, and exotic instruments with names that require advanced degrees to understand have created webs of interconnection that make it impossible to assess where risks actually lie. When counterparties start failing, the cascade effects will be faster and more devastating than anything we've seen before. Insurance companies that wrote policies assuming low volatility and steady returns now face the prospect of massive payouts when markets crash. Life insurers that guaranteed minimum returns, property insurers that underpriced climate risks, and liability insurers that failed to account for litigation risks all face potential insolvency when their assumptions prove wrong. The social safety net these companies provide could disappear precisely when it's needed most. History doesn't repeat, but if you ignore it, it will crush you all the same. The market is flashing every warning signal that preceded the greatest crashes in financial history. The question isn't whether the bubble will burst. The question is whether you'll be one of the few who saw it coming, or one of the many who believed this time was different. If this opened your eyes, hit subscribe. The lessons are all there, waiting for those willing to learn them.